Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
And welcome to the Investor Coaching Show. I'm Paul Winkler, talking the world of money and investing. All I can think of is Evan's probably going to finish my sentences for me. Evan, Ira, in here with me.
What's up?
Guys. All right, so it's
too cold to be outside, Paul.
because you don't have anything better to do? Is that basically what you're saying?
Not going for any motorcycle rides right
You're
now.
not going for any motorcycle rides. You're like, I don't have anything better to do. Might as well hang out with Paul.
We nerds are like hobbits. We want to stay inside where it's warm and just enjoy a good meal.
Okay. I can
Or
take
a good radio
I can take
show.
a hint.
Or a good radio show.
I can take a hint. So there was... Oh, shoot. I can't even figure out how to use your phone. Evan, you just take your phone back and I'll do it from my memory. I think I'm pretty close.
It's kind of like your
Where did
phone,
I send
Paul.
it to? It was sent to me, wasn't it? It was sent to me and I didn't
Talking
send
about
it
the
to
study?
you guys. Yeah.
Is that gold study?
Yeah.
Why don't
Yeah.
you tell us about that?
Was so... Why don't you tell us? Good lead in. Oh, gosh. So
Everybody put your lane assist on in your vehicle.
Yeah. So, well, you know, this is important because
It really
it is
is.
like the most asked question
Yeah.
by far that I get every place. I got this friend of mine is putting all her money in gold or and she's putting all her money in silver. She's putting, I get this question all the time. And of course, you kind of get tired of the same question, but you feel like you've got to address it because people are asking it still. So what we did is, I got to talking to the guys at the meeting this week, and I said, hey, I got this idea, and I'm, Brian, would you go and do some research on this? So Brian goes and does some research on it, and really bang up research on it.
Yeah.
But basically what I was looking for, I was looking for a period in history where gold had a good run. Had a good run up. And the reason it had a good run up was because of fear.
Yeah.
And it just so happened to be a period in time when a Democrat was in the presidency.
Well,
At the start of the period.
Well, I'm just thinking you're beginning to sound like an insurance company picking a really good period to prove an equity index annuity.
And I was not. I was looking for something that had nothing to do with what the performance was, but
Right.
everything to do with people's attitudes.
The malaise and all. Yeah.
Right. Yeah. The concerns that people had at that point in time. So what we did is we just picked, the Carter administration, late in the Carter administration. And, it was basically when a period of time when gold was being talked about pretty significantly. Matter of fact, it was the year before the article came out, The Death of Equities. Stocks are dead. Forget about it. This is Business Week talking, saying, forget about it. It's dead. Don't bother with the stock market. It's just a waste of time. And people are investing in real estate. They're gold and diamonds and futures and, all of these other
My dad
things.
was doing that
Really?
at the time. Yeah.
Okay. So, yeah, a lot of people were. And so what happened is that we took the data and we said, okay, so what if I had put my money in gold and took $1 million is what basically Brian did, took $1 million and said, what if I put $1 million in gold? Then he put $1 million in silver. And then he took an interpolated 60-40 portfolio. So in other words, what that means is that we have this group called GIPS, Global Investment Performance Standards, and they actually analyze the returns of clients in the portfolios that we use. And it's all academic. That's basically what I was convinced made sense, is use academic research in investing. And then what they did is they actually looked at the actual client returns after expenses. Now, expenses used to be way higher than they are now. Expenses have come down significantly because it's less expensive to manage a portfolio now. I mean, it's just a whole different deal. So now what happens is we're using data from not only when expenses were higher, but we're going way back. And then before that, since we didn't have the data prior to 1992, we actually had data on of the asset categories, based on what the asset mixes would be, and went back to the year 1978, and then said, well, what if we took an income of $1 million, and we got $1 million, and we're going to take a $40,000 income, and we're going to increase it for inflation each year? What would happen had we done that?
Yeah.
Well, Evan, you may remember the number better than I did, even because I was showing to you, but what was it like?
I think gold ran out in 16 years, as I recall, and silver ran out in 13 years.
Yeah.
You were out of money.
You were out of money.
You mean you were out of gold and silver?
You were out of, You basically take your gold and you turned it into dollars and spend it. And little by little, you sell a little bit of gold each year.
The coffee can in the backyard had nothing in it.
Yeah. So in essence, you go and pull the money, you take and this is ignoring expenses.
Well, I was thinking about that this morning, actually, thinking about the study and what you had done. And I was thinking.
We were being very kind to gold and silver.
Well, we were, because when you look at the spreads on those things, between the buy and the sell side of the market, let's say gold's $1,000 an ounce. Well, you can sell it for $1,000, but if you're going to buy it, it's $1,030, or something, or $1,050.
Right.
And so
that's what people don't understand.
None of that
markups.
Study showed any kind of commission being paid on the sale of the gold and silver to fund the spending for that year. I bet it would have run out about a year or two sooner.
I think that's absolutely right.
Well, to put the commissions into perspective, a very dear friend of mine, I'll actually see him next week, is a jeweler.
Okay.
And he told me that when he's buying gold, he's buying it, there's like an 8% markdown.
8%?
And then about
8%?
And then a 7 to 8% commission.
Evan was just using 3.
A 7 to 8% commission when a markup. So he said there's about a 15 to 16% spread.
Wow.
Between what he's buying it for and what he's selling it for.
That's way worse than real estate.
Yeah.
Or stocks.
Well, no, stocks. Stocks are pretty much nothing nowadays.
Right.
Well, you have so much trading in the stock market that, the bid offer spreads have come way down.
Yeah.
It is ridiculously low compared to what it used to be.
Yep.
So in bid offer spread, if you're wondering what that means, it's like when I use the example of NyQuil. I'm going to go buy NyQuil and they mark it up. When Kroger gets it, they mark it up and they sell it to you. And that would be the bid offer spread. So, yeah, so we looked at that and then we didn't look at, somebody was asking me this question yesterday, I think it was. Somebody was asking me about, well, gold, what do you do with gold? And I says, well, some people have to store it and they have to pay to store it too.
Right.
Correct.
If you're storing it, or you'll have a mutual fund, that owns gold, and then basically what they do is they have a management fee on that. So yeah, that's ignoring all expenses. And when you take a 60-40 portfolio, so if you're just joining us, it's you take a 4% distribution, $40,000 on $1 million portfolio of gold or silver, and you run out of money pretty quickly. 13, 16 years, somewhere in that neighborhood. Whereas if you had done this in a 60-40 mix, and this is, like I was saying, audited returns, client audited returns, and before that period of time, you basically have estimated returns based on the asset categories held. You end up with an ending account value of $16.5 million. $16.5 million.
Now, is that more than zero, Paul?
Say what?
Is 16 million more than zero, Paul?
Just a bit. Just a bit.
I can live I can eat past Evan, 1994 Evan, is what you're saying.
Evan, there are 3 kinds of people when it comes to math. People can do math and people that can't. So, which one are we?
Right.
Yeah, right.
Isn't that crazy?
Yeah, that is crazy. It is crazy.
No one plans on a 13-year retirement.
No.
And leaving nothing to the kids.
Well, so, why is this? Well, it's a commodity. There is no cost of capital when it comes to gold or comes to silver. It goes up and down based on supply and demand. Number one. Number two, the thing that I often point out, because gold and silver and anything like that has its own function for its own demise, which is that if the price of gold or silver goes up so high, we are going to mine for more of it, right?
The extraction costs become sustainable.
Yeah. I'm going to the bottom of the sea because I can afford to go to the bottom of the sea to get more gold or silver.
Yeah.
So you look at that and go, okay, it doesn't make sense. But, anyway, that I thought that was a fun study. And, I have all kinds of ideas for a workshop on that. I'm going to walk through, my thought is to walk through, the history of where we got the idea that gold and silver, you have people that talk about, in ancient times, we would maybe buy and sell things for, gold and we might have coins that were gold and that was used for that. And then I want to walk through why during the 1930s, we walked away from the gold standard, what was going on, what was happening in the economy, the problems with it, walk it through, even, just the depressions and recessions and all of those types of things. And I had thoughts about walking through just why it is that inflation, how it works, and just talk a little bit about different types of metals and different types of things that might have been used for currency in the past. And, I think that'd be an interesting workshop. I'm still working out in my head everything that I want to talk about regarding that, but that'll probably be some kind of a workshop that we do down the road before too long. So you guys notice that IBM has a new 401k strategy?
I missed that news, Paul.
Yeah, they have basically decided, very interestingly, to do away, very controversially, with the matches on their 401ks. And
so they're not like going to some weird plan. They're just getting rid of their match.
Yeah, they're getting rid of the match and they want to replace it with a pension. They want to go old school.
Oh, defined benefit, really?
Because it will be way cheaper.
Interesting.
And they're really complaining about it for all the reasons that we have complained about annuities before.
Oh,
It's interesting because they're really pitching a fit regarding this, because what is a pension? It's kind of like an annuity, right?
Well, if you think about it, when defined benefit or pension plans were created, the social model was, I graduate school or graduate high school. Mm-hmm. I go to work for a company for 40 years.
Yep.
And I get the pension from that company. Well, when you have any kind of multiple, 1% a month or, per year and all those kind of things, that's a pretty decent pension and all that. And they have, they have the death statistics on their side, mortality pretty down pat.
Right. Sure.
In today's society, if you don't stay with an employer more than 3 or 4 years and they've got a defined benefit plan, you're likely going to end up with next to nothing as far as the company's input for that.
And that's exactly what they're talking about here. Yeah.
Well, most companies, you have a 5-year vest before you're entitled to any kind of pension. They're probably looking at the fact that the number of employees from, let's say, 20 years ago has really shrunk. So they don't have as many employees. And they are probably looking at the turnover of the employees and figuring out, what? Even if they're there 5 years, they may only have, a 15% payout versus maybe a 40% payout of the average high five for somebody that stays for 30 years.
And what they're talking about in here is precisely that regarding the problem with this. You've got, they said they're replacing contribution with non-cash credits. In other words, IOUs.
Oh boy.
In a separate pension plan.
Did the government consult on this plan by any chance?
It could be. No, the government at least has a COLA.
Social Security Administration.
At least the government has a COLA, Evan.
Giving advice to the IBM for
at least they have, cost of living increase. These credits will earn a low rate of interest. What I always talk about regarding annuities, because people talk about why it is we don't like annuities is because of the rate of return. These insurance companies are backing their investments with bonds. You basically are looking at not much of anything. They'll earn a low rate of interest when the employee won't even see until they quit, retire or get laid off, the employee will miss out on stock market participation, which is where you make the big bucks. And if you were in compliance, you would say potentially make the big bucks.
There you go.
The maximum contribution an employee can get each year is slashed by 17% in value. And they're going to save a crud load of money by doing this. They're going to save a tremendous amount of money. So I wonder if it'll end up being something that happens in the future. You may
trend,
have to,
yeah,
because you look at these pensions, and it may have worked out for your parents because they didn't worry about very long life expectancies.
Right.
Number one, they stayed with an employer for a long period of time. You didn't jump
Correct.
from one employer to the next.
Yeah.
You could see why this would be very attractive to a corporation, but not so attractive to a participant. So,
well, and they were afraid to invest, as we've talked about in the past, at various workshops and all. They were scared out of the market in the Depression era, and those were the people that worked for companies for 30 and 40 years, and they had just an unnatural fear, of equities because they had seen misbehavior. Markets do what markets do.
And that's a good point, Evan. It's a lot of times what we do is we hear stories about people getting bad returns in stock markets historically, and it isn't because of bad returns in stock markets so much as it is simply bad behavior and how they approach it.
But another thing, as I'm thinking about this, the money that goes into the pension, let's say you're 24, you go to work for the company, you're there for let's say 5 years, so you fully vest in the plan, so you're entitled to a benefit. Mm-hmm. If the money's let's say the company is doing a safe harbor plan and they're required to put in the 3% for everybody into the 401k, at the end of 5 years, you just take that money, you walk away.
Right.
With the money in the pension plan, you're
talking about a safe harbor plan. You don't even have to wait that long. You don't wait at all. Because you're vested immediately.
No, that's what I'm saying.
Oh,
but
okay.
That money is out, away from...
okay. I gotcha, yeah.
From the company.
Right.
So now in the pension plan, that money's going to stay in your company. Let's say, 25...
You forfeit it.
24, they started 25, you're there for 30. You're not getting any money for the next 35 years.
Right.
But that money in the plan that they're putting in is going to grow, but the money that for the employee is not going to be such a great benefit.
Right. Yeah, and I think that's the issue. If you have people moving from job to job, and which is what people do, that's where the issue comes in. Thanks for tuning in to the Investor Coaching Podcast. Now, you may be one of these people that's been listening and realizing, wow, investing, there's a lot more to it than meets the eye, and financial planning, tax laws constantly changing, and recognizing that maybe you might need some help in this area, but you don't want just anybody to help you out. So we have 10 offices in the Middle Tennessee area, and everything that we do is fee only. We align our interests with your interests. So you can get an initial 15-minute phone call with any one of our offices just by going to paulwinkler.com/call. That's it. Every one of the offices is run by somebody with 20 plus years experience. They're all degree planners. They all have academic backgrounds in investing, and you can get the help that you need. So if you want to set up a complimentary phone consultation, just go to paulwinkler.com/call. And we look forward to seeing you soon. Guys, I sent this to you because I thought this is sneaky stuff.
Yes.
So you probably, you hear me talk about from time to time here that one of the things that I like putting on our website are little workshops that you can go to whenever you want to go. And you can learn about topics that sometimes you'll see in libraries, you will see taught at restaurants, you'll see taught at universities or whatever. And the topics are things that people want to know about. They want to know about how Social Security works. They want to know how Medicare works. They want to know these tax things and things like that. So what I do is I just go, you know what? Here's what we're going to do is we're going to put them up on our website. And if you just want to go watch these videos on these things to learn about this stuff, you can go. But you don't have to sit through a presentation on an annuity or some other investment vehicle that you shouldn't be buying. You don't have to sit through anything like that. You just go learn about this stuff. And you know, that's one of the things that bugs me is that so often that's what people are doing. They're going to these workshops and they think, hey, yeah, I do want to learn about that. And they're sneaky now. You know, they're going and renting university classrooms to make it sound like it is at a university level, or it makes it look good. Or they're going to the local library, which is, you know, you think of studious people. They're going to spend their time in a library. Well, now I get this thing, maximizing Social Security. And they got adult financial education services. And it's important 2023 changes. And I'm like going, oh boy, what's this going to be? And, you know, class sizes and seating limited to ensure your safety.
Yeah.
What on earth?
I enjoyed that conversation online.
I mean, that was hilarious. I mean, it was classroom size limited for your safety.
In case terrorists are targeting Social Security workshops now.
Yeah, you know, I'm not exactly sure what to think of that. But you know, that was one thing. And then you know, they have in there. They have this little thing about how it works. And what this are. It's a nonprofit. And it's a nonprofit, and you think, well, nonprofit means they don't make any money. Well, not technically.
The library doesn't make money.
Well, you think about it. When you have a nonprofit, what do you have working for that nonprofit? Employees that
Volunteer?
No. No, they get a paycheck, you know, so, you know, you get a paycheck and you make money, but you don't have to call it profit because you don't own an entity. And it's just a little bit misleading. But then you have these different companies that, you know, go, well, who's going to be teaching this workshop at your local friendly university? And it is going to be, you know, Ira, Evan, either one of you guys that have the thing that I have there. What does it say? What was the first page? I forgot what the first page said. You guys have that, I don't. It's benefit of not having my phone with me.
Yeah, sorry.
Or do you want me to read it?
I'll hand it to you. I wasn't sure what you were trying to do.
Well, I just want to walk through what this thing is.
Our courses are taught by instructors who are active participants in the financial service industry.
So this means, by definition, investment salespeople. You know, I guess they could be fee-only advisors, but, you know, I just hold out my doubts that that's what it is. And, you know, they're holding it at a university. They're saying for many Americans, Social Security, it's this thing that, you know, that they don't really understand. They don't know what to, they don't know what to make of it. And that's true. A lot of people have confusion regarding it. But in essence, what we're going to do is we're going to put together this workshop, and in there they say, you know, our process differs markedly from the typical Wall Street approach to financial planning because it considers all available options rather than just the narrow band which is traditionally touted by Wall Street and its representatives. I don't know what that means exactly, but they're all taught by instructors who are active participants in the financial services industry. And this says, our instructors do not advocate shortcuts or secrets to wealth or investment gains. But this is why I have my great doubts about this. They rather a conservative approach that fosters predictability, stability, and availability to match the current and future needs of the individual, which screams annuity, 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 annuity. I mean, what is something that I don't have to, what most people would call conservative?
Right.
You might call gold or silver conservative based on that last conversation we just had, and you ran out of money.
Right.
If you go and stick all your money in CDs or treasury bills, you can be conservative all the way until you run out of money, and then you don't necessarily look terribly conservative, in my humble opinion.
Yep.
When you run yourself into the ground. Evan.
Yeah, well, you know, thinking about that, once you hit 55, you start getting a lot of those things in the mail. But Facebook is where I get a lot of my ads. Mm-hmm. And this one came up but it's along the same vein, especially on talking about the other stuff. Protect your savings using this tax loophole. So, of course, all that gets attention. Loophole. Are you trapped in a cycle of limited retirement investments dictated by Wall Street and banks? Don't let fear hold you back any longer. Now, listen to this and see if you can guess what they're talking about.
Okay.
This secret IRS code unveils a massive hidden perk in all red typeface.
Okay.
It's so simple it could save you thousands. It grows your retirement account tax deferred.
Okay.
Here's the interesting thing. If you look at this on the footnote,
Okay.
do you want to guess first or not?
Well, annuities would be tax deferred. It wouldn't be
think.
secret.
That's
or
where I was
life
thinking.
insurance is often talked about in that term.
It is. Well, here's this tax loophole.
Uh-huh.
And in the footnote, once you give them your email and phone number, I've read the privacy terms and authorize Allegiance Gold or someone acting on their behalf to contact me, including by text message, ringless voicemail, or on a recorded line, blah, 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 blah.
Okay.
So here, this secret tax-deferred loophole is buying gold in an IRA, and they act like this is a brand new thing and
or
makes
it's good.
sense,
or
like,
that it's a good thing to do with your IRA.
I mean, it's just great. I have this secret loophole. I can run out of money in 16 years.
Yeah, that's
Wonderful.
I think there are better loopholes out there, but
Yeah. Who knew?
So
IRAs are a loophole.
I had one of a colleague that lives in Ohio send me a text message.
okay.
Annuities have come a long way. Example, such and such company has a 5-year product. 0 fees. I asked them when this particular company became a philanthropic organization instead of an insurance company.
0 fees.
Only a 3% commission. Annual cap of 11% per year with 100% participation in the S&P 500. 11% cap is guaranteed not to be reduced over 5 years. So here we can say, well, it's conservative. I can use the word guarantee in it. Predictability, well, I can get 11%. If the market goes down, the worst I get is 0. Only issue is you only have access to 10% penalty free each year. Great bond alternative.
Yeah.
He writes. So I basically talked about surrender fees. What if you need more than that? The product is not going to pay 11% over the 5-year period. It's a 5-year point to point, meaning if you get it January 1st of 2000, December 31st of 2004 was the full 5-year period.
It's a 5-year point to point?
Or annual point to point.
Okay.
But you're going to, if it's up 14, you're only going to get 11. If it's up 28, you're only going to get 11. If it's down up 3, you get 3. So these things.
But if it's down, here's the important thing. What happens if it goes down and it goes down 20? You had, let's say you had a 30% return. You get 11.
Right.
And the markets do that from time to time. And then it goes up 20%, you're going to get 11. So you go, well, I'll take that. Well, if you think about it, what happens is you go up that much, it can go down that much and take away all your upside because the downside is not limited.
No.
Usually not.
So yeah, that's the way they work. They don't limit the downside; they limit the upside, and that's where they get you.
So I brought up these things. She said,
"What's that, Evan? You're nodding no."
On an annual point to point, that value would reset.
Right.
So if the market dropped the next year, they'd get 0. They wouldn't see a reduction in their value.
Right.
Where you,
they're going to lock
get
in
all
the
of the
11.
downside.
The monthly they do that.
The monthly
they
totally.
do that. Okay,
Yep,
the
just wanna
annual they
clear that
don't
up.
do
Yep.
that.
Right.
Correct.
Okay, so wait a second. So if you get 0,
Yep.
then
Well, then you have a 5.5% return over 2 years.
right.
But if you're up 28 in year 3, you only
Right.
get 11.
Okay.
So long term, the S&P has outproduced these things.
Right. Well, the research that I've seen, you go 30 years and you have returns that are the same as bonds. We got to take a break. Let's do that. Listening to the Investor Coaching Show. Yeah, see, so obviously, Paul has never sold these things because never believed in any of them. And now I know, that I didn't realize that those 5-year. I've never even seen a 5-year.
I haven't either.
So that's interesting that even existed. So that's why. Okay. Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. You want to learn more about what we do, go to our website, paulwinkler.com. You can watch some of the videos there, and if you're not already a client, you can set up a free initial consultation. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler, Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.